Crash Course on Finance. Time Value of Money. Gain an understanding of the time value of money and its importance in finance. Sure, let's dive into finance and understand the concept of the time value of money. The time value of money is an essential concept in finance, which refers to the idea that money received or paid out at different times has different values. It is based on the principle that a dollar today is worth more than a dollar received in the future, as the dollar today can be invested and grow over time. Therefore, the time value of money is a critical component in various financial decisions, including investment, borrowing, and capital budgeting. Let me give you an example to make it more understandable. Suppose you have a choice between receiving $100 today or $100 after 1 year. If you take the $100 today and invest it at a 5% annual interest rate, you will have $105 after 1 year. On the other hand, if you take $100 after 1 year, you will have only $100. Therefore, in this scenario, the $100 received today is more valuable than the $100 received after 1 year. Top 12 popular evaluations of time value of money. 1. Present value (PV) is the current value of a future sum of money or cash flow discounted at a specific rate. It is used to determine how much a future sum of money is worth today. 2. Future value (FV) is the value of a current sum of money or cash flow at a specific rate of interest or return in the future. It is used to determine the value of an investment or asset at a future date. 3. Net present value (NPV) is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. It is used to determine the profitability of an investment or project. 4. Internal rate of return (IRR) is the discount rate that makes the NPV of an investment equal to 0. It is used to determine the expected rate of return on an investment. 5. Payback period. Payback period is the amount of time it takes for an investment to pay back its initial cost. It is used to determine the length of time it takes for an investment to become profitable. 6. Discounted cash flow (DCF) is a method of valuing an investment or asset by estimating its future cash flows and discounting them back to their present value. It is used to determine the intrinsic value of an investment or asset. 7. Effective annual rate (EAR) is the annual rate of interest or return that accounts for compounding over a given period of time. It is used to compare the returns on different investments with different compounding frequencies. 8. Annuities. Annuities are a series of equal payments or receipts made at fixed intervals over a period of time. They can be used to calculate the present value or future value of a stream of cash flows. 9. Amortization. Amortization is the process of paying off a debt over time through a series of fixed payments. It is used to calculate the amount of each payment and the interest and principal components of each payment. 10. Bond pricing. Bond pricing is the process of determining the value of a bond based on its coupon rate, face value, and maturity date. It is used to determine the market price of a bond. 11. Capital budgeting. Capital budgeting is the process of evaluating and selecting long-term investments or projects. It is used to determine which projects or investments are most profitable and should be pursued. 12. Mortgage financing. Mortgage financing is the process of obtaining a loan to purchase real estate. It is used to calculate the monthly payments and total interest paid over the life of the loan. In summary, the time value of money is a fundamental concept in finance that allows investors and businesses to make better decisions about how to allocate their resources over time. By understanding the time value of money, investors. And now, as requested, here's a poem about the time value of money. Ime value of money, a concept so old, yet still so important, it never grows cold. The value of a dollar, today or tomorrow, can vary greatly, causing financial sorrow. Investments and loans, they all depend on the interest rates that never bend. Compounding and discounting, the math may be tough, but understanding it is more than enough. If you invest today, you'll earn more. Tomorrow's dollars may be worth less for sure. Opportunities lost, they never return. The value of money, we all must learn. Net present value, internal rate of return. 12 evaluations, there's so much to learn. From annuities to perpetuities. They all require careful abilities. So plan ahead, and don't procrastinate. The time value of money, don't underestimate. Your financial future, it's in your hands. Understanding this concept, the key to all financial plans. *****, start planning your next global adventure with ease and convenience with our Booking.com referral link. https://www.booking.com/index.html $aid equals 7989335 as a great choice to plan your next trip. you can find in book flights, hotels, cars, and local attractions all in one place, and their price match guarantee ensures you're getting the best deal. Thank you for kind support our Anhub Metaverse channel, and please watch more interesting videos here.